if we see this price run continue upwards, there's a sort of clear incentive there for these gold miners to continue to kind of pump some of that cash flow into growing their output, into increasing their efficiency. So they're not just kind of chasing these prices, but actually broadly improving their operations.
Hello, you're watching Proactive. I'm joined by HANetf product specialist Harry Halewood. Harry, very good to speak with you. After moving sideways for so long, why has gold suddenly seen this reversal of fortune?
Yes, so thank you very much for having me as well. So as you mentioned, after hitting all-time highs, all-time price highs in January of this year, gold has since drawn down by about 35% since the end of February, and that shows a real dislocation from the behavior that we usually expect from gold as a sort of somewhat defensive safety asset. And we've seen over the last week or so about an 8-9% jump in the value of gold. Now, the decline over the last few months has been tied closely to events in the Middle East and some of the uncertainty from that kind of shaking markets. There'd been lots of increase in holdings of gold up to the point of that all sort of kicking off. And actually, that meant that gold was then a very liquid asset that investors, central banks, whoever could draw down to kind of mitigate some of that risk. So that was a big contributor to that decline. Now, it's hard to put an exact kind of reason onto the reversal that we've seen over the last sort of week and a half, but essentially kind of up to that point, the market had baked in quite heavily some of the sort of negative outlook that we had for gold. And then what we saw last week was a US jobs report that came in slightly below expected. So there was no kind of detrimental decline, but there was some sort of job destruction as opposed to the kind of minor job creation that was expected. And then following on from that, the US CPI, the Consumer Price Index, was published. And again, with that, we saw a quite neutral readout. There was a sort of slight increase year on year, sorry, month on month, kind of to the level that was expected. So there were no surprises there. But because the market, again, had baked in this sort of real negative outlook, actually that somewhat neutral outcome in terms of jobs, in terms of CPI, meant that there was a kind of positive response from the market where there was it kind of allayed some fears that the market had of an imminent rate hike from the US Federal Reserve. And actually, that, like I say, despite being a fairly neutral outcome, led to a relatively positive market response. And that fed through into gold as gold is a non-yielding asset. There's essentially no benefit to kind of sitting on it other than that a capital gain, that price return. So actually, when the outlook for kind of US rate hikes becomes a little bit more dovish within the market, you see people moving their money back towards these non-yielding assets away from things like treasury bonds that would have provided that ongoing return were those rate hikes expected to occur.
Harry, given all this, why might investments in gold miners be viewed differently to gold?
Yeah, so there's an interesting distinction between the two. Kind of at its core, gold mining investments are a sort of conviction play on gold. So that, becomes relevant in the context of what I've just discussed in terms of this improving outlook and, slightly more optimism, certainly in the sort of short term around gold price movements. But the big difference between the two is that gold miners are a leveraged play on gold conviction. So instead of gold miners making a kind of absolute return on price movements in gold, their return is dependent upon their margin of mined gold above all-in sustaining costs. So that's the kind of full suite of cost inputs required to mine that gold. And essentially what that means is because their returns occur above that minimum cost base, as the gold price increases, their returns are dependent on that gap. So actually, it's kind of exaggerated. So if we look at an example, Newmont, they're the largest gold mining company in the world, and heavily present in a lot of the gold indices. Their all-in sustaining cost per ounce mined is about $1,600. And for some of the larger miners, this is kind of it sits somewhere in the middle. I think the broad average is closer to 2000, but certainly for these big miners with economies of scale, that's kind of where their costs sit. And what that meant is, if we look at the recent price increase, we saw gold jump up in value by about 9%. But in sort of Newmont's case, that actually meant that their margins grew by 14.5% because, like I say, it all happens above this minimum cost base. So you can see there how there's a little bit more leverage in the gold miners market. And if we're seeing this gold price reversal kind of back to those positive trends, it allows a sort of leveraged exposure to that. You've also got slight differences in terms of, gold is just a pure commodity, whereas if you're investing in gold miners, taking a conviction position in a company who are exposed to gold prices, but they also have the opportunity to invest operationally. They can sort of push those costs down as well as driving prices up. And it just provides kind of a slightly different approach on playing out that gold conviction.
With those differences in mind, Harry, what could the recent move mean for miners?
Yes. I mean, again, as I say, the sort of obvious answer to that is a sort of more than proportional increase in revenue. So if we kind of look at the price that gold had maintained, it bottomed out around $4,000, but it had been kind of trapped between these two upper and lower limit points for quite some time. And with, something like this, where you see a stock, commodity, etc., break out of those limits, it can be, the precursor to a bit of a run. So had the gold price kind of broken through that lower limit, obviously depending on market conditions, it's never a guarantee, but we might expect to see that continue a downwards run because we've seen it break up through that upper limit. There's every chance that, uh, you know, uh, dependent, like I say, on market conditions, with all these market forces willing, we might see a continued run in the positive direction. Now, the specific impact on miners depends on the nature of the mines. So if we look at, events in the Middle East, the impact they've had on fuel prices, open pit mines require a lot of heavy machinery. That obviously then requires a lot of kind of fuel. And that means that, if the impact of the oil prices that we're seeing from the Middle East is more significant, um, if we look at kind of deep pit miners where they're ferrying things up and down through these kind of mine shafts, it's less dependent on that kind of thing. But I mean, as we see, tensions there potentially start to dissipate, there's not necessarily any sign of that happening in the near term, but that provides a kind of slightly idiosyncratic influence on miners versus specific gold investment. And then again, as I said, you're investing in a company, not just a commodity. So there's also potential for reinvestment and growth. So, like I say, we might see a sustained bounce in the positive direction if this kind of gold price increase is sustained. And we've seen from earnings releases over the last few weeks that miners, despite the drop in gold prices, despite the uncertainty around input costs brought on by the closure of, the Strait of Hormuz and other global events, they've maintained significant cash flows. In fact, many of them, the sort of earnings releases that I've read through have showed cash flows for the second quarter beating records for all previous second quarters. So they're still sort of very healthy financially. And actually, they have kind of put some of this cash flow towards investing in capacity. They've invested in increased efficiency. They are sort of broadening their locations. And if we see this price run continue upwards, there's a sort of clear incentive there for these gold miners to continue to kind of pump some of that cash flow into growing their output, into increasing their efficiency. So they're not just kind of chasing these prices, but actually broadly improving their operations. And then in parallel to that increased incentive, you've got, far increased cash flows from that gold price increase, again, that they can then apply to improving their efficiencies, growing their kind of extraction footprint, and ultimately, again, providing that sort of slight icing on the cake in terms of following that gold conviction upwards and taking these extra returns over that pure commodity exposure.
So could this be part of a broader rally for gold miners then?
I think there's definitely potential. I think, as with everything, it depends on a huge amount of kind of external factors. But I think with gold in particular, as we've seen recently, it can be so heavily influenced by global events. I mentioned at the start the extent to which some sort of clearly directional indicators from the US in terms of CPI print and jobs data has massively impacted gold. I would say kind of more than proportionally to the extent of those actual changes. The price moved quite dramatically for events that, like I say, do have a sort of directional element to them, but ultimately have not been described as anything too existential in terms of their input on the US economy. But that does mean if some of these events start to move in our favor, if we start to see a relaxation of tensions in the Middle East, it's hard to predict when that might ease, but that economic sigh of relief could definitely be positive for gold as expectations of sort of inflation and rates start to abate slightly, rate increases, that is, start to abate. And then kind of all that in mind, margins for these gold miners are still incredibly high. So, like I said, having come down about 35% from January highs, following that sort of gold price correction, the average all-in sustaining cost levels of these miners' outputs, sort of across the market, sits near about the $2,000 mark. And we've seen gold prices now jump from 4,000, where, their margins above those costs were still 100%. And bearing in mind, this is broadly at a kind of low point for the gold mining sector. They're now continuing to climb. They now sit around 4,400. So, where those all-in sustaining costs stay quite static, we've now got a $2,400 margin above those $2,000 costs. Um, so the market is still looking very strong. And this is during a period of stress. These gold miners have sustained those cash flows, they've sustained that performance, and as I mentioned, have managed to continue to invest. Their capex and their cash flow yields have been climbing. So you can see they're kind of putting money into their operations without having to take up big amounts of debt. They're financing this internally, so they're all in a very healthy position. So I think, like I say, it's hard to call anything with any absolute certainty, but there's every chance that if a few dominoes fall in favor of gold and of gold miners, the strength of their kind of performance could be maintained.
Harry, thank you very much for your insights. I'm sure we'll be chatting again soon.
Yes, I hope so. Thank you very much.
That's Harry Halewood, product specialist at HANetf.